Well, hello once again to the Smart Money, Dumb Money Show, and I am your host, as usual, Keith Richards. And I'm President and Chief Portfolio Manager of Value Trend Wealth Management. And this is part of our video series where I bring in special guests, and I'm really excited about today's guest. I've actually known Bruce Joseph, I guess, something like 10 to 12 years at least, maybe longer. And we met in a coffee shop in Barrie, Ontario. And at the time, we just started talking about what he does for a living versus what I do for a living. We're both kind of in the investment world, and Bruce has a background in the investment world, but he's moved into real estate. And he's been featured on BNN TV, as well as a lot of common media sources that you'll be familiar with, the Globe and Mail and various media sources, as an expert on real estate trends and developments. And so I'm really excited about bringing Bruce in because I'm not an expert in that area, and yet I'm fascinated with the issues within Canadian real estate. You've seen me blog a couple of times recently about the problem with Canadian real estate, but Bruce brings a unique perspective, both as a longtime mortgage broker, but he also is responsible for managing a secondary mortgage market. I think they're called MICs. And so Bruce's perspective, I think, is going to be very interesting to this audience, and I hope you get a lot out of it. And so I'll welcome Bruce, and I'll just ask him to start off with, Bruce, your perspective on what's going on in Canadian real estate. Welcome, Bruce.
Well, thank you very much, Keith. So I think, when I typically get asked to opine on real estate, it's generally focused on the credit side, because that's where I'm active, and that's essentially mortgages. And what's really fascinating, I think the most fascinating thing right now in the credit is, a lot of investment into real estate has slowed due to rising interest. We've had, I believe, one of the most aggressive interest rate hikes since like the 80s, close to within a 12-month span, almost like 5% on mortgage rates. So obviously that's had a bit of a substantial impact on prices and demand. We've seen some general markets drop by as much as 30%, but the overall national home price index is something like 13, which is, again, you got to go back to the 70s to get these kind of numbers. But what I think is really interesting is the kind of information that I have into the optics into the private sector. We can get a lot of data on banks and arrears and extended amortizations, but there's virtually no optics into this very large portion of the market, which has grown extremely fast in the last couple of years, enough that the regulators have taken a note of, and quite a bit of Canadian investment capital that's poured into. So, I mean, that's probably what I find most fascinating, is what's happening in that market and the impacts it'll have in the general overall economy.
Yeah, so I mean, you're right. It's interesting seeing the decline in Canadian real estate prices, which really were a long time coming. Let's face it. And I mean, you no doubt are just as in tune as I think most of us about how Canadian real estate versus world markets has really what I like to call hockey sticked. It's everything was going up, but it's really hockey stick since the COVID crash and all that sort of stuff. So you and I were talking about a week or so ago before this interview, when I first started talking about setting this interview up. And one of the things that you brought up, and this is an area of massive interest, I think, to me and many people watching this, is the market on the secondary mortgage market and what's happening. You mentioned a firm actually just in my town in Barrie that is struggling right now, having put the stake in the ground at exactly the wrong timing, and now they're struggling with how much they're going to be able to sell their condos for and that kind of thing. So tell us about your view and what you've seen in the secondary mortgage market.
Right. So, I mean, for a bit of context, I kind of break the market into three sort of areas. So you've got your prime side, and that would make up your Canadian chartered banks. And that's really interesting to follow. And there's a lot of data there. And then you've got your alternative banks, which are still banks, but they operate slightly with wider, let's say, qualifying criteria, and their interest rates are higher. And then you've got your basically, years ago, they used to call it the shadow banking sector. I just hear it called like the basically private sector, which is made up of wealthy private lending individuals, and mortgage investment corps likely dominate that market. So what's interesting about that is virtually all, not completely, but virtually all mortgage investment corps have essentially 1-year terms. They don't do 5-year terms. They're all essentially 1-year terms that reset. And when they reset quite higher. Now, it's important to note, they are the lender of last resort. When they decide not to fund, it's very typical that nobody else is coming to fund those mortgages. And they are generally focused specifically on the value of a property. So if you're in a particular market where you've got a 30% drop in a valuation, there is a very high likelihood that those private lenders are not going to renew their mortgages. So we had a big run up last year at a certain point, actually around this point last year. And now a lot of these mortgages are coming up for renewal near the end of this quarter. And there's been a significant erosion in equity. So I think, the next couple of months are going to be really telling, because the way I see that is that translates a portion of those mortgages on those books being put into for sales, where there are no other lenders coming to the rescue. And how that impacts prices is really going to be determined on, the overall, demand at that point in time. And it's, I'm not saying it's abysmal at this moment, but it's the sales volume numbers are still like really low, even though they've upticked a little bit in the last few weeks from previous years.
So that's interesting. I didn't know that about like the secondary or non-primary, whatever you want to call them, lenders as generally having a 1-year rollover. That's, wow, talk about timing. I mean, the rates, what they've done in 1 year. So you can imagine, and I did see a statistic that we're seeing a greater number of walkaways. I'm not sure, Bruce, you'll know the right term for it, but people that maybe did sign on to buy a subdivision or a condo property, whatever, and are just walking away. Is that, can you fill me in on that?
Yeah, I think that's going to be a much bigger event later in the year. Like new construction coming online, new builds right now at this moment are still relatively low. But from what I understand, it looks like we're going to have a very high, near the middle end of the year, number of new construction projects basically hitting the supply. And that's where we're really going to see, it's definitely a problem. It's a problem because when you go to close on these properties, you have to be qualified through a bank at the current market valuation. It doesn't matter what price you paid for it. They're going to evaluate these prices, right? And you have to also take into consideration that you may have qualified for your mortgage at, low 2%, and now you might be in the mid 5s and mid 6s. So I think that's a big problem. To what scale is yet to be seen. But that would likely turn into people walking away from their deposits. And, from there it can be really uncomfortable depending on which builder they're dealing with.
Yeah, that's, in fact, I've seen, I know I've just posted another blog where I noted that in the US, they're starting to see some pickup. And I guess you were just saying there's pickup happening just recently in Canada as well. So am I reading you correctly in that you're not 100% convinced just yet that this recent pickup, especially in Canada, is the real McCoy? Are you skeptical, or what is your outlook as far as, say, the bullish versus bearish outlook on real estate over the next year or so?
Yeah, I mean, I'm very skeptical about it, but I'm not convicted either way either. I've had some pretty strong convictions in the past based on some high level data, and the market's been irrationally, I don't even know what the right word is, been able to
exuberant.
Yeah, but even almost like irrationally resilient too. Like the resilience of it is really surprises me. So I mean, the one sort of if you want to call it a bull case, but something that could maybe put a floor under is some of the data I've seen and just some of the individuals that have amassed such an incredible amount of wealth in real estate over the years. There's an argument that there's a certain floor at which they will simply begin buying these properties. I can tell you, overlooking a brokerage, we do have clients that own 20 plus properties, and that's not uncommon for most brokerages to have those type of clients. So investor related type buyers know how to acquire these properties in scale. It just could be like a wealth shift in that. So there's that factor, but the immigration numbers are really interesting. So like part of the bull case is I think we had something like 800 plus thousand total immigration last year, which was the highest number ever. Too high likely, and I think we're rolling over this year probably 500 plus. So there is something there. I'm just not totally convinced that's going to be the metric that, you know, I don't see any evidence that the market's going to skyrocket. I'm just thinking of like what could cause it to like have this nice sustainable floor. But on the bear side, I mean, there's a lot of evidence that things look fairly uncomfortable. To me, the most glaring piece of evidence that is the number of transactions on sort of the transfer of ownership of a piece of real estate. So that's real estate agents, mortgage brokers, insurance companies, lawyers, etc. That number is like really down. So, I mean, last quarter, you know, we were looking at close to like 40% for the entire industry in transaction volume, you know, down. And those are all dollars that go into some of the highest spenders in the Canadian population. And that just has a really broad effect. So there's that. I think that's a big thing. And it's also important to note that real estate agents, mortgage brokers, et cetera, are some of the largest buyers and servicers of debt against real estate. So that's something to keep in mind. It's pretty concentrated there. So I would say that's really part of the bear case that it's going to be very uncomfortable. But there's also two other things. Like there's a psychological effect of interest rates and like how people feel about, you know, buying anything. Like I don't know that buyer psychology is positive right now, given interest rates. It's going to take a while for people to normalize to where we're at. Just the sheer affordability of just getting a mortgage today versus 12 months ago is still really uncomfortable for people. I think that's a major thing. But those two things alone are fairly massive. But I think throughout the year, we're going to see a little bit of a bump in, I really think a bump in distressed sales, and probably something that most of us can't recall. Like the last time we would have seen this would have been decades ago. So I'm not, if I had to guess, I would be fairly, you know, fairly not certain, but I would have a strong feeling that could affect buyer sentiment as well. I feel like that could have a real way of dragging down buyer sentiment. So I think the bear case is fairly strong, and there's a lot of data to support that.
Yeah, it's well, just as a quick aside, I may end up putting this data in a blog coming up, but this got nothing to do with real estate, but it maybe ties in a way. I just read a study of revenue and purchases and, you know, gross revenue coming in on the luxury end of the world versus the sort of mid-level, not the low level purchasing end of the world. So for example, you know, I was talking to somebody this morning and they're a scuba diver, they want to buy an underwater camera. Well, those sales are slowing down. Like it's because people are squeezed for groceries, for gas, things like that. Their rent's gone up, their mortgage has gone up because of course that interest rate hike, if they had to renew or if they were on a floater, all these costs have gone up. So maybe you don't buy the camera that you wanted to buy. It was maybe only a $600, $700, whatever purchase, but it's $700 you don't want to spend right now. Versus the high end, this graph showed that sales of Ferrari, Louis Vuitton, you know, these kind of things, you know, are doing really well. Like, I mean, Ferrari has the same chip problem that all the car makers have, but there's a lineup. Like I'm a Porsche guy and I like Porsche cars, and I know that, there's certain Porsches you can't get. Like, doesn't matter how much money you got and how you can't get them. And so there's this lineup, to get these high-end things. And that probably translates out to the real estate market, I think, in that, there's a certain level of people that will just, they're going to benefit by this because their cash flow, when the timing is right, they'll step in, and interest rates or not, they'll be able to buy a property cheap. Whereas, maybe not so much the general population. So that's food for thought. And on that subject, and so this is, I wanted to ask you, I wrote down my questions, so that's why I'm looking down. Private lending. We were talking about this a couple of weeks ago when we last spoke, and it's increased over the years, and this is like across the board thing. Why is that?
Well, yeah, that I can definitely opine on. So mostly the demand for private capital has steadily grown. So most borrowers, at least that I'm exposed to, that, I mean, you could put them into two categories. One would just be they're distressed, lender of last resort. In my observation, that hasn't been the largest percentage of borrowers that borrow at 7s and 8% interest rate ranges on private capital. They're typically borrowers that are self-employed, that don't qualify. They can make the argument that it makes more sense to pay these rates than to not acquire the real estate. There's also quite a bit of speculators that will buy at those rates and hold mortgages at those rates. So, there's two components. So one is who wants these mortgages and why is the demand higher on that? And I think a lot of that just had to do with, the rise in real estate prices. You could easily justify private rates last year when you're getting that kind of expansion. A little harder right now. But on the flip side, investors also really enjoyed, especially when we're at 2%, but really enjoyed just a high fixed yield that came with mortgage investment corp returns. That seemed, to be something that drove investment capital into MIC funds all across the country. And I think just to piggyback on that is it's just a really simple investment. It's not difficult to get Canadians to want to buy real estate. There tends to be it's a thing here, right? So to invest in debt against real estate is not a far pitch either. So I think that was like a natural transition for people who wanted to have less exposure in direct real estate and have something slightly more passive. So I could see where the demand was really heavy and why it just exploded on both sides. That's why it's going to be really interesting now, because some investors that invested in mix took out levered investment. So we're talking, and I spoke about this years ago, saying in any particular corrective environment, this would be a problem. If there was a MIC that was very levered, because once the spread goes negative, or they would have significant redemption issues, and that blows up the model. So I haven't observed that yet, but when I'm thinking of problems in the mixed sector, it's likely there would be particular funds that are heavily levered.
Okay, so yeah. I have another question that maybe is appropriate for the viewers, as far as, because the viewers of this particular video are investors, we're stock traders, we're bond people, we're buying normal securities as well as commodities and that kind of thing. So the question I have is, like, when a lot of people in my business, we may say, okay, real estate looks good or real estate looks bad, and so you can buy REITs, real estate investment trusts, that might focus on residential rental properties or commercial rental properties. And there's also the peripheral companies like Caterpillar and those that kind of feed off of, and lumber and whatever, that feed off of the whole real estate market. Like real estate, a lot of, even the banks, if you think real estate is going to do well, you buy banks, because of course they're going to sell more mortgages. So the question I have is, are you seeing any distinguishing trends that might separate, say, commercial versus residential residential rental properties, like those three areas? Are you seeing like a commercial property still doing just fine, and is
Right.
there any distinguishing features between them?
Yeah, so I'll just opine from a high level on this. I'm definitely not an expert on commercial. Our brokerage does fund those. What I've observed is industrial real estate seems to have been quite resilient. Certain types of commercial, not so much, like office space or retail. Specifically certain types of retail where you may have restaurants or clothing stores, etc. And that's understandable given, the rise of Amazon and just the efficiencies of technology. Clearly, residential has been struggling. I mean, and certain pockets have been really struggling. I would say certain rural areas have. I mean, some of the rural areas expanded so unbelievably during COVID. It made no sense, but the psychology of people was almost madness for a couple of months. I mean, we saw prices in some of the most rural areas of Ontario going for valuations which would never make sense again, likely. So I think residential clearly, especially more in the condo market, is where I'm sort of observing the biggest likely problems. But as far as commercial, it didn't see the same run up, so it wouldn't have seen the same erosion either. But one thing I'm thinking about when we're mentioning this is sometimes I think about what I want to focus on is where we might see, if we do, where would we see the cracks. So often it's going to be, okay, well, what are the lenders of last resort doing? Are there problems there? I was speaking with a fantastic analyst about a week ago about that very question that overlooks sort of much more higher macro level data. And he geared me towards, when you're looking at banks, what you got to realize is that, during the time of COVID, when we were doing mortgage deferrals, when you look at the particular percentage of principal repayment, it was at an all-time low because we were deferring it. Because of the extended amortizations from a 5% increase in interest rates, the principal repayment of Canadian mortgages right now is actually lower than it was during the COVID crisis. That's really, really fascinating. But from a more, let's call it, positive way of looking at things, I don't think we're going to see any immediate erosion there. But one of the things the analyst mentioned is there may be a lot of distress in just straight business loans, which I would definitely have observed on the commercial side of our lending arm, where you've got businesses just taking out unsecured loans, restaurants, retail stores, you name it. The sectors that are really struggling right now, there could be, I think there's some obvious and right now, issues with that. So to conclude all that, I would say I'm seeing more problems in residential real estate where people were over levered last year. And most of the commercial industries, depending on what they are, if they're not in the obvious categories, seem to be quite resilient.
Yeah, that's the impression I got, was definitely the commercial side is okay. And I just did a little bit of an exploration on different types of REITs, which is not precisely what you do, but they're, you know what a REIT is, real estate investment trust. And there's different REITs you can buy for different, sectors, and that includes commercial versus residential and whatnot. And you're right, yeah, you'll notice that the ones that are more people orientated versus commercial orientated are doing worse as far as they go. Now that brings up a question. So you were just mentioning, yes, that the individual homes, so somebody goes in and bought, say, last March, right around the peak, March of 22, they bought this house that at one point, just 2 or 3 years before, was selling for 500, and now it's selling for, at that point, was selling for 800 or 900. I mean, that's how much these things I saw, anyways, jumped. And now maybe they're down. They bought at 800 or 900, and now it's down to 700 or something, or even lower. So you were saying, there's some distress coming out of that sector. But what about with residential? There'll be some investors that will buy maybe a small apartment or a residential condo type of situation that they plan on renting out. So are any of these people showing any distress, or is the rental market, as far as residential people are concerned, are they still paying their rent, and are the investors in those properties still doing okay from what you've seen, or what do you see?
Yeah, I would say for the most part, but also depending. I mean,
Mm.
if you're a new landlord that entered the market in February, March, April of 2022, and took out a variable rate mortgage, and I think, at the lows, I believe it was close to like 60+% of all bank originated mortgages at the all-time lows were variable rate mortgages, right? So if you were running your rental spread on those numbers, you would be completely distressed right now. It would be likely having to sell. I just don't think that is a majority of like a lot of the exposure I've had to buyers that own multiple properties have been accumulating real estate for multiple years. I don't think brand new rental investors made up a significant portion of the market last year, but at least for the ones that did, they're going to have a problem. Whereas if you own an apartment building or a couple detached properties in the last few years, unless you went really high on the leverage scale on the equity take it with a variable rate mortgage, they're likely fine. What I am seeing, though, is the quality of tenants for a lot of the big apartment buildings and large landlords that we work with seems to have been declining. And that might be just because of the overall economy as a whole. But I have been hearing that seems to be a consistent trend, that quality tenants that can pay are becoming harder to find.
Oh, sure. Yeah. I mean, so many reasons, inflation and that kind of thing. Wait till the recession starts affecting employment. I mean, it hasn't yet, but it will eventually, because if you're producing less goods, that means you need less employees to make those goods. It's kind of funny how things work. So I have one last question for you, Bruce, and this morphs into those surrounding industries that I was talking about that circle around real estate. So one of the sectors that we follow really as a barometer of real estate, but investors are interested in this sector, is the builders. So there's, like, in the US we have DH Horton. What's the other one that's pretty big? Anyways, there's a few of them. I blogged on them before, but they're still, what I'm reading in the States, we don't really have any publicly listed builders and developers in Canada, but there seems to be a trend that they're starting to see slowing, like less shovels in the ground, so to speak. What is your take on that? And is that just temporary, or any thoughts on that, like how they might be doing or their outlook over the next few years?
Yeah, I mean, I speak with some mid-sized builders. The really large ones in Canada, you're right, they're mostly owned by private families with exceptional wealth, like generational wealth. There clearly is going to be some challenges with like smaller levered builders that are relatively new to the game. But for a lot of the builders I've spoken with, they recognize that a major pivot is occurring. Some of the builders are changing, because I mean, one of their biggest challenges is costs, right? The inflation cost of building a house today is so much higher. Often what gets missed too is the quality of labor. There seems to be, for many multiple reasons, getting quality labor today seems to be more cumbersome than it might have been a few years ago. So you match that with rising costs and an uncertain price tag, a lot of uncertainty on, if we build this in a rising cost environment and we're projecting selling this at, rolling the dice on what the valuation is going to be, you will tend to see, at least what I've observed, is some builders looking to get into smaller, more affordable projects, so they can keep on, rolling out inventory and ensure that the sales actually occur, versus maybe building like multi-million-dollar McMansions and subdivisions, which are no longer accessible to the general population like they were the last few years.
Yeah, that's, to your point. I have two sons that are both truck drivers, and the one son is involved in construction. So the construction son, he has all these different licenses. He can do cranes, he can do cement, he can do, you name it. He's the guy in his company. If the boss wants to go pour some cement, he says, Bryce, just go to this spot, and here's the stone slinger, the cement truck, the crane to bring, whatever it is. The one son can get in that car or that truck and and go do it and operate the crane or whatever it is that he's been trained on everything. So he's very in touch with the construction industry. And he told me, and this is what you're mentioning with the McMansions, or like, let's say custom homes. Like I have a custom home myself. I didn't buy into a subdivision. I bought a piece of land and built a home on it. Many people do that. Well, my son said, look, it's really hard to get, for example, cement right now. So he goes, the custom home guys, they're in deep trouble, because who's going to get the cement? The person putting up 20 new houses, or you in your little lot that you would like a basement for next week, And he says, so these guys are always put on the back burner, and literally custom homes are taking much, much longer now to get built, because of, like, you're always shoved to the back for a lot of these supplies. And like you said, tradesmen and stuff, it's just hard to get good workers, like you said. So that's an interesting point you bring up. And again, part of my reason for being interested in real estate is because of my kids. they're involved, So well, listen, any finishing words from you on the state of Canadian real estate that you'd like to leave the viewers with?
Yeah, I mean, it's the greatest minds I've spoke to that really have their finger on the pulse on the the longevity and where this is all going. Very few people I know have a very strong conviction of any sort of even long-term projections throughout the year. We're kind of all looking at the factors and kind of seeing where it goes. But it's going to be really fascinating and interesting to watch. It's going to be an exciting year in real estate.
That's one word for it, isn't it?
That's the best word I can come up with.
That's great. Well, listen, Bruce, thank you for coming on. I've talked to you in the past, probably for a couple, 3 years now, about, doing something with you like this, because I wanted my people to hear from you, and your perspective is so different from the stuff they hear from me, with all the technicals and the markets and whatnot. So this is really, I think, going to be a well-received conversation. And I really appreciate you taking the time, because I know you're super busy. You're always on the go. Every time I try to talk to you, I get your voicemail. So this has been a great opportunity. And thank you so much for coming on.
My pleasure, Keith. Thank you for having me.